Hello and welcome to FT Markets. Well, it's been a long time coming, but we finally got the first big blockbuster US employment report on the first Friday of the month. Joining me now to discuss what this means for the Fed and for markets in general, Garcia from Alphaville. Cardiff?
You feeling as good as I am, Mike?
Feeling very good. Yep. Everyone's happy for Christmas. We've got falling gas prices here in the US. Everyone can go driving. Everyone's got extra money to spend now on the shopping for Christmas. It's all looking good. So where does this put the Fed?
I mean, this is probably as close as you can get to an unambiguously good jobs report. And crucial is that, especially crucial is that wage growth finally appears to be perking up a little bit. There were other reports showing that, other economic indicators showing that it might be picking up just a bit. I mean, still not a lot. But at least now there's nothing you can really point to and say, well, here's the big caveat. Here you had great jobs growth, you had decent wage growth, you had a longer work week. I mean, this was across the board a pretty good jobs report, and I think it's worth feeling good about. In terms of the Fed, well, this is a little bit complicated, okay? So first of all, I think they're going to want to see at least a few more reports to see if this kind of trend can keep up. And the reason is that we need to know if these initial signs of wage growth continue, but also remember that the inflation outlook doesn't look like it's going to change anytime soon, right? You mentioned oil a little while ago, the stronger dollar, and the Fed does have a responsibility to get inflation back up towards 2%. It hasn't really budged in quite some time, and so I think this really complicates their lives a little bit.
But I suppose one of the interesting things, before we had the payroll data this week, we had both William Dudley from the New York Fed.
That's right.
And also Stanley Fischer speaking. And they seem to be saying we are getting ready for liftoff. They seem to be sending a message, even before this jobs number came out today, that the bond market and indeed investors in general should realize this is a Fed that wants to raise rates. But I suppose the other factor here is as oil prices remain under pressure and the dollar continues to rise, the dollar itself, as it becomes stronger, acts as a sort of form of tightening financial conditions here. So that can stay the Fed's hand for a while, but ultimately it does look like we are going to be seeing a rate hike in 2015.
Oh, sure. And the Fed, by the way, has kept its options open. I mean, if they do end up doing it in March, there's going to be a lot of debate about whether or not that's too early. But it wouldn't come as a huge surprise, especially if we get a few more jobs reports like this. In terms of those two speeches, I mean, it's worth noting that Dudley's speech I thought was notably a little bit more dovish than Fischer's speech. Fischer made the point that the decline in oil prices and the pass-through to inflation would likely be a temporary phenomenon. Dudley has emphasized for quite some time that it actually might be worth allowing the unemployment rate to dip below the Fed's estimate, its projection for the long-run unemployment rate, in part to help inflation get back up towards 2%. He said that it might be worth letting it run a little hot. And what's interesting about that is that he still seems to think that the Fed should hike rates sometime in mid-2015, but he also said that they would be carefully monitoring the reaction of financial markets, which is really intriguing. The idea that if the Fed starts to hike and financial markets have a big freak out, they don't necessarily need to keep up some pace of rate hikes. They'll take that into account in terms of what they do next, suggesting that the path of rate hikes might again be very shallow.
The other interesting question, I think, is this is a Fed that obviously is scarred by what happened in 1994.
Yeah.
I mean, they raised rates quite aggressively that year. We saw probably, I think it is actually one of the worst ever years for the bond market in general. Stocks also fell quite heavily that year, then rebounded from 95 onwards. But I also feel at the moment we've been at near zero rates since 2008.
Yep.
6 years. Do you think the Fed needs to actually communicate to the bond market and say, look, we're not actually tightening policy here, we're just normalizing policy.
We're just calibrating it appropriately.
Yeah, and I think that could be the way we see things unfold next year. I think the big question for the bond market and indeed the Fed is just how aggressive will the ECB be next year? If they really open up the spigot and really try and get inflation back up in the Eurozone and actually try and push global inflation expectations up,
sure,
that would actually help the Fed here and allow the US economy to maybe absorb and remain what many people on Wall Street currently think is an island, i.e. it's immune to global growth slowdown
sure,
and the global deflation.
But partly that depends on how the dollar reacts as well.
That's as well.
It's a really interesting issue. I mean, there's a lot of moving parts here. Some of this depends on the extent to which the Fed worries that rates continuing at zero are leading to further dislocations in the financial markets. But we have to keep in mind that it doesn't actually have a financial stability mandate, right? It has to take into account financial stability, but its mandate is for full employment and for inflation. And with inflation still below its explicit target, I think that's going to be a huge issue next year, a big part of the debate, especially if the unemployment rate starts to get down towards the Fed's estimate for the long-run unemployment rate, which is, again, is higher than it was when we went into the recovery, and maybe that'll be adjusted down. We don't really know. So there's so much that could happen next year, and I don't think the Fed has any easy options. I think this is going to be a big source of debate in the coming months. There's this December meeting coming up in just a couple of weeks, but my sense is that they're not going to actually want to make any moves before March, certainly. But even in the time leading up to that, I think this is going to be a very prominent source of debate. How do you weigh things like financial stability, like the fact that rates have been at zero for a while, the fact that inflation will continue to run below its target for some time, and the fact that we're now starting to move a little bit closer to the Fed's long-run projections for the unemployment rate? I think that's a fascinating trade-off, and we just don't really know what the outcome is going to be. It's what makes this so exciting.
Yeah, and I suppose when you think back to what happened in mid-October, we had a massive liquidation of the rate hike bets, particularly amongst the hedge funds out there. They're licking their wounds, and yet here we are about to go through another round of trying to price in the Fed and hope this time they're on the right side of this trade, because this is a trade that has burned a lot of people really since 2010, when we all thought liftoff was going to start occurring even that far back.
So, like I always say, you can't fight the Fed. You can only hope to anticipate what it's going to do, but if you fight the Fed, you're going to lose.
Well, on that note, Cardiff, thanks very much.
Thanks, Mike.